everyone, welcome to a new RRG video, recording this on Thursday the 20th of November, and the US market has just closed with a serious decline, 1.5% down for the S&P 500 and the Nasdaq a little over 2%, but the biggest beating was in the technology sector with a loss of over 3%. So it's a good time to review the RRG framework for portfolio composition, which we introduced 2 videos ago, and I promised that I would continue to update that, and that's what we're going to do. Let me start with the positions where we left last time I updated this, and that was the 6th of November. So we had a very clear preference for stocks and commodities. Crypto and cash were underperforming, and the fixed income asset classes were underperforming, and within the bond section it was very clear that you needed to be overweight in the longer dated bonds and underweighted in the shorter dated bonds, the shorter maturities. And the sectors, we had communication services and tech as the outperformers. We had energy, utilities and healthcare as upcoming. And we had materials, financials, industrials, staples, and real estate as underperformers, and consumer discretionary was starting to weaken, starting to roll over. In the commodity space, it was industrial metals and precious metals which were leading the charge. Agriculture was coming up, energy and livestock were the underperforming groups in the commodity space. That's where we left it off. Let's have a look at what happened and how we are going to change that. Starting at the top with the asset class RRG. It's a weekly RRG. I use the weekly RRGs to fill this framework. And you can see that there is now a rotation starting up, a pretty clear rotation, where there's absolutely nothing inside the leading quadrant, which is interesting, but the benchmark it's the diagonal that you look at for the equilibrium. And that's also for this one because it's VBINX, which is only stocks and the fixed income group. So the only thing that is encompassed inside the benchmark is SPY, HYG and LQD. Commodities and cash and Bitcoin are not in the benchmark. And then it's balanced out pretty evenly. But what worries me is the direction. If you look at the direction of SPY, the tail, that is now starting to move at a very clear negative heading, where the fixed income asset classes are on the opposite side at a positive heading, and they're now starting to move further towards the leading quadrant and closer to 100, where SPY is doing the same, but from the other side. And that's that scissor type move. Stocks are still on the right hand side. So from a longer term perspective, I still have to say that stocks are the preferred asset class. But for the near to, I'm going to say medium term, next couple of weeks, it absolutely looks like stocks are now going into a pause, and that's being compensated by positive rotations for the fixed income asset classes. The asset classes that are doing really well is commodities. So DJP and GSG, that's the one here in the middle, are picking up speed, and so is the US dollar. The US dollar is absolutely strengthening, and you can see clearly the underperformance of, in this case, Bitcoin, but I'm using that as a proxy for the entire crypto space. And what that means for my rankings, my opinion for the asset classes is that I have moved the fixed income asset classes, so GOVT, LQD, and HYG, from underperform to neutral, but I also have downgraded or lowered the outlook for stocks from outperforming to neutral. Commodities are remaining an outperforming asset class, crypto remains underperforming, and the US dollar is now definitely a neutral / positive asset class. So that's the change for the top level for the asset allocation space. I want to take a look at 2 individual charts from the asset classes. That's SPY, obviously, and GOVT I want to look at. And what you see here is that First of all, on the price chart, there's now a pretty nasty bar. The week is not closed yet. We still have one more day to go, but this is a pretty nasty bar, very long, and we're currently trading at the lower end of that range. That is affecting the raw relative strength line, which is coming hard down, and that is impacting the RRG lines. The green RS momentum line had already dipped below 100, indicating a loss of momentum, but now the RS ratio line is starting to pick up steam to the downside, and that's pushing the tail of SPY further into the weakening quadrant. And I'm going to take that as a warning signal, hence the neutral rating for the stock market. The second chart I want to talk about is GOVT. That's government bonds. And let me blow that up a little bit. And you can see that we're still trading under that overhead resistance, which is around 23, 32. But the RRG lines, the relative strength, it's hard to see here because this is a quite long chart, but it's starting to pick up. It's starting to put a bottom into place. And you can see how that is dragging both RRG lines up. The momentum line is already above 100. And red RS ratio is starting to pick up, positioning GOVT inside the improving quadrant, starting to move at a positive heading. So for the time being, I'd be feeling more comfortable with a position in GOVT rather than SPY, or at least an overweight in GOVT and an underweight in SPY or neutral. Definitely not a strong overweight for SPY anymore. Definitely not a strong underweight for government bonds anymore. Let me jump to the commodity groups first before we start attacking the sectors. Here is the rotation for the commodity groups, and that is mainly unchanged compared to a week and a half ago. We still have industrial metals and precious metals inside the leading quadrant. They are losing a little bit of relative momentum, but that's not major yet. And we see GVK, which is livestock, GV, which is livestock, now rapidly moving into the lagging quadrant. We already had that at an underperformance because it was right here and was accelerating, and it has now crossed over into the lagging quadrant, making it a clear underperformer. And that is the same for the energy index. That is picking up relative momentum. But as you can see here, that's almost a vertical line. And when you get that vertical move on the RS momentum scale, and no pickup in relative strength, because then it would have moved to the right and that would have created that positive RRG heading that we like. But this is still a almost vertical move. And for that reason, I'm keeping that as an underperformer, because it is only a relative momentum move and not an uptick in relative strength. What is upticking in relative strength is GKX, and that is agriculture. So the agriculture group in commodities is continuing to pick up a little bit of relative strength, but it's doing that at a stable pace, at a horizontal level in terms of momentum. It's moving in the right way, but it's not there yet. Commodities as a whole, as I said, is still an outperforming group. So what is happening in stocks and what is happening in sectors? A lot. This is the RRG showing the rotation for the sectors. And the situation that we had last week and a half ago, where communication services and tech were the only ones on the right-hand side, that has now changed. Tech is now the only sector on the right-hand side. And we have all other sectors on the left-hand side, with the blue ones in improving and this group inside the lagging quadrant and deteriorating further. And that makes for a very interesting rotational pattern, because technology is so disconnected from the group as a whole. You could actually, let me do that just for fun. Let me just tick off technology and then fit. And you see how this is a very nice, evenly spread RRG. Forget about the crosshair here. You can see that this is a nice circle. The crosshair is dragged to the right by the technology sector. So for this episode, for this week, the way I decided to approach this is to basically look at tech separately from the other groups, not entirely, but a little bit, and come up with images that I think reflect the current rotation. The first thing is I think that technology is now no longer the strong underperformer anymore. It is definitely, it's a very strong sector, but the reason why it's so high is because it had such a super long trend, and RRGs in the end of the day have a trend following component in them. And that is keeping XLK at a very high level. Nevertheless, that trend is losing strength. That trend is losing relative momentum. And that's why it's inside the weakening quadrant. And if you look closely, you can see that it's actually traveling at a negative RRG heading now. So I moved technology to a neutral rating. And just for clarification, I will show it later when I have the complete sheet with all the rankings on it. But I'm using the color coding, so green, orange, red, and blue, but it's not necessarily the position of the RRG on the RRG, the position of the tail on the RRG. What I use the color coding for is, so we got green and red, which is plus and minus, outperformance, underperformance. And then we have two neutrals, neutral minus and neutral plus, for neutral that is improving and neutral that is deteriorating. I hope I make sense. Anyway, let's continue. Let me go over all them in a alphabetical order. That's easiest. So when we do materials, that remains an underperforming sector. That tail is moving further into the lagging quadrant, no doubt about it. And then we have communication services. I changed that now to an underperformer. This is a long tail, a negative heading, pushing into the lagging quadrant. Here is energy, and energy is inside the improving quadrant, and it remains neutral with a positive twist. That's probably the best way to describe it. And then there is financials. That is inside the lagging quadrant, very short tail, which means that it is a stable relative downtrend. You don't want to have that. And then we have industrials, also inside the lagging quadrant, picking up a little bit of relative momentum, but no relative strength. Remember when we spoke about that commodity tail that was almost vertical? This is even worse. This is going up, but still moving to the left. So it's not picking up relative strength here. Here's technology. We talked about it. Rotating, inside weakening, starting to move at a negative heading. It's now a neutral sector, deteriorating. Then we have staples. That is I thought about this for quite some time. It's the lowest ranked sector inside this universe, but it's picking up relative strength, and it's one of the few sectors that is traveling at a positive heading. So instead of keeping it at an underperformer, based on the low RS ratio reading, I decided to make it a neutral, so a blue one with a positive twist, because it is starting to pick up, and I will show you some more arguments why a defensive rotation, a defensive positioning is not a bad idea at the moment. The same goes for real estate. Still a very low reading on the RS ratio scale, but it's got a positive RRG heading, and it is picking up, and it's one of the few sectors that is traveling at a positive RRG heading that we like. Utilities is actually really good. We moved that one up to outperform, because this is going to cross over into the leading quadrant. That is 99% sure that next week it will be inside the leading quadrant, unless massive things change. But I think that's what's going to happen, and I'm trying to be ahead of that move. And the same goes with healthcare. Healthcare has been climbing the ladder steadily over the last few weeks. And look how long. It's the longest tail. That means there is a lot of strength behind that move. And it's got the highest RS momentum reading. So it's a strong move heading towards the leading quadrant. It is one of the better sectors at the moment, hence the outperformance recommendation. And then the last one is consumer discretionary. And that has now rotated clearly into the lagging quadrant. I'll bring up the color-coded scheme and the color-coded framework in a minute, but I want to go over a few individual charts to underscore the changes that we just looked at. Not all of them, because that's almost all. Okay, not all, but 7 sectors have changed color, have changed position. And let me pick up a few to look at the individual charts.
If you like my videos on RRG and you like to have the same functionality as what I'm using in my videos, you need to get a subscription to Stockcharts.com. It will open up all the functionalities that I am using in my videos, and it will help you to get a better angle on your holdings and create investment ideas. So if you don't have a subscription yet, get a free trial, and after that, we'd love to see you as a subscriber to our service.
Here is communication services. Look at how that toppish formation is now confirmed. We have a first lower high, and now we have definitely a lower low. So that means that a new downtrend is emerging. We took out support. That means that the next serious support level is only found around 105. Look at the relative strength, that is rolling over. We took out the previous low, and the RRG lines are now both pushing lower. This is not a strong outperforming sector anymore. Here is technology, and look at that. That's probably even worse. It is reaching the first support level, so around, that's going to be 270. That might be a support level where we may find a little bit of support and a little bounce. But there is definitely damage done to the price chart here. And if you look at the relative strength line, it's dropping back below its former resistance level. And the RRG line, so the green RS momentum line, is struggling with that 100 level. It seems to be rolling over, and that is already taking its effect on the red RS ratio line. So technology now a neutral at best, not a strong outperformer anymore. Let me, just for fun, make this a daily chart and see how that looks. Because, yeah, that's what I thought. If you look here, you could actually argue that here is a head and shoulders top formation, which is now broken, and we're right here now. So if this is what we want to see, then the neckline would be here, let's say around 280. The peak is 305, so that is $25 under 280. That is 255 as, well, that's a nice support level. So there's definitely some downside ahead for the technology sector. Keep it in mind. Here is staples. I already told you that I thought about this for a long time because it is the lowest reading on the RS ratio scale. Normally that means that it is a very weak sector, but it is a very defensive sector. And with the current weakness in tech and in more offensive stocks, I'm keeping an eye on this one. And you can see how rapidly that momentum, that relative momentum started to improve. We've now put a new low in the RS ratio line. But also the price chart is moving in a sideways pattern. And when the market's going down, sideways is good. Sideways is outperforming as the market's going down. So that's the reason why I put consumer staples back in neutral, so equal plus as it is neutral and improving. And a similar thing is happening with real estate. Let me bring that right up here because they're next to each other. So here is real estate. And if you look at that, you know, this trend, this very shallow trend has been broken. Let me annotate that. This doesn't look very nice. This, I think this makes way more sense as a bottom. And then here we have some overhead, and this one can go now. So we have 1, 2, 3, 4, 5, 6 touch points in a sideways trading range. Relative strength is still declining, but it's hardly visible here. But the RS momentum line indicates that the pace of the decline here is rapidly slowing down, and that's pushing that RS momentum line higher, and that's now starting to curl up the RS ratio line. So in the light of the current sector rotation, the total rotation, I think that real estate is now also a neutral to slightly positive sector. Let's move to utilities. That's the other very defensive sector, but with a very strong tail on the RRG. And you can see why. I mean, here it's coming down, but it's hovering above its previous high, which is still functioning as support. There is a very nice rising trend line present, almost in the same area. And you can see that relative strength is moving sideways and starting to pick up. And we have a first higher low here. RS momentum and RS ratio are picking up. That makes utilities an interesting and possibly leading sector for the next couple of weeks. And the same we will see for the healthcare sector. If we look at healthcare, then you will see a similar picture where there is a very strong price chart pushing against overhead resistance that is around 155. I am not sure whether the market will be able to take out that overhead resistance around 155 with the current weakness, but I don't think it's going to crash down. I don't think it's going to rapidly decline. And if it does, there is support waiting at 148. We're currently at 151.5. And you can see the effect of that on the raw route strength line. That's bottoming out and starting to improve. And the RRG lines are doing the same. So healthcare is really becoming a very good sector on a very rapid pace. And then I have one sector left that I want to share with you, and that is consumer discretionary, because that's going absolutely the other way. Look at this. This is a textbook double top formation. We broke it. We're moving down. We have this old shallow falling resistance, which is now acting as support, if any. And then we have this rising support line, this old rising resistance line coming in as support. So there is definitely some support waiting here. But the upside potential for XLY is now limited to, let's say, 229, the bottom of that double top formation. But what's worse in terms of route strength is the break of support in raw RS and the ensuing rollover of both RRG lines, which is pushing the consumer discretionary sector deeper or into and deeper into the lagging quadrant. And that justifies a downgrade or a ranking with, as an underperforming sector. I think everybody agrees that this relative strength is not looking very good, and this is a very clear double top formation on the price chart. And that leaves us with the current outlook for the RRG framework portfolio construction. As I said, fixed income, neutral to positive, stocks, neutral to negative, commodities are the outperformer, crypto is the underperformer, and cash are neutral to positive. By the way, I've got to put a legenda here, so you got minus plus, that is, it's still negative but improving, so I call that a neutral with an improving twist. Underperform is minus, outperformer is plus, and neutral minus is plus minus. I hope it makes sense. Let me know in the comments if you think it makes sense or you would suggest something else. I'm very open to better ideas. I'll always change my own ideas when I find a better one. In the yield curve maturities, this is the change. So the shorter end has now moved up to improving. So they're all neutral. This means that the yield curve is now slowly flattening. It was steepening. It's now starting to flatten a little bit. Doesn't matter. It's not a big deal. It happens. But if you're really into it, you should better now start to look at the shorter end of the curve rather than the long end. Commodities are unchanged, and we just talked about the changes in the sectors. I have put a little asterisk on the ticker symbols that have changed since the previous update, so that we can, when we do this over time, we can just scroll through history and see how all these changes have taken place. So this is the previous one. I didn't do the asterisks here, and I also didn't have the legenda there. So if you look here, then you see the new colors and the coloring scheme. There's one more RRG that I want to share with you, and I'm putting this up now because we see such a strong sector rotation and the market is moving around. There's quite a bit of volatility. And this chart shows not the sectors, but various segments spread out, diversified in growth and value. And then, so we have growth and value, but we also have growth and value separated out in large, mid, and small cap. And that gives a pretty good view on where the market is positioning itself or where the market is rotating to. And that's actually pretty interesting because we have all the large cap stuff right here. So these are all large cap groups. This is growth large cap. This is, I'm lying. This is growth. So we've got growth and value. So here's value and this is growth. A rotation for the time being out of growth into value. And then when we started to break down, let me take these two out. So VA and growth, we're going to take them out. So VA and growth, you're gone. So now we only have the size, and I need the sizes. And here are value large cap in general and growth large cap. That's all three large caps are on the right-hand side. Large cap growth is rotating out of favor. Value large cap is rotating into favor. And anyone who's seen a presentation that I did on double benchmarks, that is a very good example. You could take US large cap as the benchmark and then look at, so you put an imaginary crosshair here, so put US large in the middle, and you would see immediately that value is picking up steam and growth is rotating out of favor. So large cap stocks are the place to be, and inside large cap, it's value stocks. All the others, so this is growth mid cap, value small cap, value mid cap stocks in general. This is small cap stocks. This is growth small cap. This is small value. All of that is inside the lagging quadrant. Maybe small value, DJUSVM, mid cap value is potentially interesting, but it's at a very low reading and it doesn't do very much. So in the entire space, value large cap concentrated in the sectors that we just highlighted as positive would be the cross section of where I would look for interesting stocks at the moment. Anyway, I hope it made sense. Let me know in the comments whether you liked it. And I'm going to wrap it up here for this week, for this episode. Thank you for watching, and I'm looking forward to seeing you again very soon at a new video of RRG here on Stockcharts Television.